All right, let's jump back in time to 1992 and really dig into one of Warren Buffett's most insightful shareholder letters. Now, this isn't just a history lesson. Think of it as a timeless masterclass in how to think, how to value, and how to operate. A playbook that, honestly, is probably more relevant now than ever for any serious investor.
So, first things first, why should we even listen to what he had to say back then? Well, this number says it all. From 1964 all the way to 92, Berkshire Hathaway's book value per share grew at an absolutely staggering 23.6%. Compounded. I mean, that's not a lucky streak. That's the result of a crystal clear philosophy that was executed relentlessly for decades. That is the authority behind every single word we're about to explore.
And here it is. That entire philosophy boiled down into a single sentence. This is the North Star for Berkshire. It's not about getting bigger for the sake of it, not about building an empire or hitting some quarterly number. Every single decision gets filtered through one simple question. Does this make the individual owner wealthier on a per-share basis? That's it.
So that leads us right to the first core principle. You have to think like you own the entire business, not like you're just renting the stock. The day-to-day stock price, that's just noise. The real game, the real focus is on the underlying long-term value of the whole company. Okay, so if the stock price isn't the scoreboard, what is? It's this, the annual increase in per-share intrinsic value. Now, of course, intrinsic value is always an estimate, right? It's not some hard number you can look up. In the letter, Buffett explains that he uses book value as a, quote, conservative but useful proxy just to track their progress over the long haul. All right, let's get into one of the most important jobs of a CEO and something that's absolutely crucial for us as investors to analyze, capital allocation. This is where Buffett sees so many managers just completely go off the rails, learning really expensive lessons about why getting bigger often just destroys value. To show you what he means by this institutional pressure to just grow, Buffett tells this fantastic story. It's about a bank manager who was so, quote, hell-bent on expansion that he agreed to a merger that massively overpaid for the target company. And the best part? The seller's one condition for the deal was that the buyer had to promise he would never, ever do something so value-destructive again. It's a funny story, but it's such a sharp critique of growth for growth's sake. And this brings us to his famous corporate toads metaphor. You have these managers, they get completely enchanted by the idea of some transformative acquisition, and they go out and pay these huge prices for totally mediocre businesses. They kiss the toad, hoping for a prince, but, well, it's just a toad. And the shareholders, as Buffett puts it, are the ones left paying the tuition for the CEO's very expensive education. What's so great here is how honest Buffett is about his own evolution. He freely admits he kissed a few of those cheap toads himself in the early days. He learned the hard way that just buying cheap junk isn't a great long-term plan. And that's what led him to shift his strategy from the old cigar butt style, buying fair businesses at good prices, to the strategy we all know today, buying good businesses at fair prices.
Now, let's get to what I think is really the intellectual core of this entire letter. This is where Buffett takes on one of the most persistent and, in his view, just plain wrong debates in the entire investment world.
We've all heard this a million times, right? Are you a value investor or are you a growth investor? The market just loves to put these two ideas in opposite corners, as if you absolutely have to choose a side. But Buffett says this is just totally fuzzy thinking. And here is his powerful, simple conclusion. They are not opposites. They are, quote, joined at the hip. Growth is just one piece of the puzzle, one variable in the equation you use to calculate value. Sometimes it's a huge positive variable, sometimes it's tiny, and sometimes it can even be a negative, but it's always part of the exact same calculation. So what's he talking about? Well, it all goes back to this universal formula from John Burr Williams's classic book, The Theory of Investment Value. This definition applies to everything: a 30-year bond, a high-flying tech stock, a boring old consumer goods company, you name it. The only thing that changes is how hard it is to estimate those future cash flows, those future coupons. And this is the real acid test for growth. He points to the airline industry as a perfect example of what he calls profitless growth. For decades, the industry grew like crazy, but it constantly needed more and more capital, and it never earned a decent return on that capital. For investors, it was a total disaster. The takeaway is simple. Growth only adds value if it's profitable growth. Okay, so the theory is beautiful, it's elegant. But how do you actually apply it in the real world? especially when trying to guess those future coupons is so incredibly difficult. Well, this brings us to the practical, boots-on-the-ground foundation of how Berkshire actually operates. It really comes down to this two-part creed. It's all about discipline. First, you stick to what you can understand. If a business is too complicated or changing too fast, you can't confidently predict its cash flows, so you stay away. It's that simple. And second, you have to insist on a margin of safety, a classic idea from Ben Graham. You only swing the bat when you can buy something for way less than what your conservative estimate says it's actually worth.
His purchase of General Dynamics in 1992 is just a perfect case study of this in action. It actually started out as a simple arbitrage deal for him, but as he started digging in and studying the company and its CEO, Bill Anders, his, quote, eyes popped. He realized the true intrinsic value was way, way higher than the market was giving it credit for. So he just dropped the short-term trade and became a committed long-term owner. That deep understanding revealed a massive margin of safety.
All right, now for a concept that really separates the amateurs from the pros. Let's pull back the curtain and look at the financial architecture that fuels the entire Berkshire investment machine, the insurance operation. At the heart of this whole thing is this concept of float. What is it? Well, it's the huge pile of money that Berkshire gets to hold on to and invest because customers pay their premiums today, but Berkshire doesn't have to pay out claims until later. Given the massive scale of their insurance businesses, this float is a gigantic, permanent pool of capital they can use. But here's the billion-dollar question. What does this capital cost? And this is where the magic happens. The cost is just the net result of their underwriting. If the premiums they take in equal the claims and expenses they pay out, the cost of that float is zero. Think about that. They get to invest billions of dollars for free. And if they actually run an underwriting profit, they are literally getting paid to hold and invest other people's money. And this table just shows the incredible result. Just look at the cost of funds column compared to the yield on government bonds. In 1980, Berkshire had $237 million in float at a negative cost, while the U.S. government was paying almost 12% to borrow money. By 1992, they had over $2.2 billion in float. This isn't just an advantage, it is a durable, structural competitive advantage of almost unimaginable power. Of course, insurance is a risky business. Buffett was writing this right after Hurricane Andrew, which was the biggest insured loss in history at the time. And he uses this classic line to make a point. A major catastrophe is the tide going out. That's when you find out which companies were being disciplined and had strong balance sheets, and which ones were, well, swimming naked. So, let's wrap this all up. Let's distill the letter's final lessons into a set of yardsticks that any professional investor can, and probably should, use to evaluate businesses today. First, look beyond the reported GAAP numbers to what he calls look-through earnings, which include the retained earnings of the companies Berkshire owns stock in. Second, demand intellectual honesty. He absolutely rips into the absurdity of not expensing stock options, saying calling a tail a leg does not make it a leg. Third, you gotta balance a long-term view with the need for results now. And finally, always remember that lean, low-cost corporate structures are a huge competitive advantage, not a sign of being cheap. And that leaves us with one final question to chew on. Buffett wrote all this more than 30 years ago. This focus on intrinsic value, margin of safety, intellectual honesty. So which of these core principles do you think is the most dangerously ignored in the market we're living in today?